Welcome, everyone, to the Deep Dive. Today, we're bringing you something a bit special, our Bulls, Bears, and the Bell Afternoon edition.
That's right.
You've asked us to take a really close look at the market action from Monday, August 25th. And, well, we've gathered a pretty formidable stack of insights from various sources.
We have indeed.
We're not just going to rattle off numbers here. Our goal is to, really dive deep into the financial markets, try to dissect the day's movements, which were quite nuanced, and actually make some sense of all these swirling forces.
And it's genuinely fascinating, I think, to see how global markets are positioned right now. They're really at a critical crossroads. Leading into Monday, we'd seen this really powerful rally, right? Fueled largely by central bank expectations, lifting risk assets pretty much everywhere.
Big surge Friday.
Exactly. But Monday itself felt very different. It was less about pushing higher and more about strategic consolidation, almost like the market taking a breath, doing some careful reevaluation. It's not just reacting to headlines anymore. It's carefully weighing these complex, sometimes opposing forces and positioning for what's next.
Right.
You've got this widespread hope, almost expectation of a Fed interest rate cut. That's a huge tailwind.
Okay.
But then pushing back against that, there's this rapidly building wall of worry, and it's mainly focused on two things coming up: crucial inflation data and a really, really important tech earnings report.
Absolutely. And that's our mission today, really, to go beyond those headlines, to pull out the most important nuggets of knowledge from all these different sources you've shared with us. We want to offer you, our listener, a genuine shortcut to being incredibly well-informed. Not just what happened, but why markets moved the way they did, what those moves really signify, and crucially, what you should be watching for next, especially with all these mixed signals flying around.
Trying to cut through the noise.
Exactly. Aiming for that aha moment, getting to the core insights. So let's kick things off with that global picture, because Monday, August 25th, it really showed a fascinating divergence across the international markets.
It really did.
You can almost picture it like a global relay race. Asia seemed to grab the baton, fresh energy from Friday's news, especially Fed Chair Powell's dovish signals, and they just charged ahead.
Yeah, they ran with it.
But then you look at the U.S. and Europe, and it felt like they hit a strategic pause, taking a collective breather, maybe looking ahead at the hurdles still coming this week.
That's a great analogy.
So while Asian stocks surged on that renewed optimism, the U.S. and European markets mostly paused their advance. And they were coming off record, or near record highs in many cases. What's this divergence telling us about the underlying mood?
Well, that relay race analogy is particularly good because this divergence, it really highlights these two potent opposing forces that are driving global markets right now. On one side, you've got this incredibly powerful tailwind, the primary one we've been tracking. This widespread and now, I think, firmly entrenched expectation of a Federal Reserve rate cut.
Right. It feels almost baked in now.
It really does, especially after Fed Chair Jerome Powell's speech late last week at Jackson Hole. That was a real game changer. He pretty explicitly signaled a rate cut could be warranted maybe as early as the September meeting.
And he cited the labor market.
Right.
Shifting risks.
Exactly. He talked about a shifting balance of risks, growing concerns about the U.S. labor market potentially cooling, and this clear prospect of cheaper money, this liquidity injection, as people call it. That's significantly lifted risk assets worldwide. It makes borrowing cheaper for companies, for consumers, and that makes growth investments like Starks look a lot more attractive.
Okay.
And that's the positive vibe that Asian markets really grabbed onto, because Monday was their first chance to fully price that news in.
Right. So Asia was essentially just playing catch-up to the good news that already hit the West on Friday.
Precisely. That's a good way to put it. But then on the other side of this, delicate balance, we have what our sources are calling this formidable wall of worry.
Okay, the wall of worry. What's it made of?
It's not just one thing. It's really built on two pretty significant pillars right now. Pillar number one, the upcoming personal consumption expenditures, or PCE, price index for July.
Ah, the Fed's favorite inflation gauge.
Absolutely their preferred measure, and it's due out this coming Friday. Now, here's the catch. If that report shows inflation is still sticky, persistent price pressures,
Still running hot.
running hotter than the Fed wants, It could seriously complicate that dovish pivot. It might force them to kind of temper their guidance, even if they do cut in September, and that would definitely dampen market enthusiasm.
Makes sense. And the second pillar?
The second pillar is the massive, highly anticipated Q2 earnings report from NVIDIA, the AI bellwether. That's due out on Wednesday.
Right. That feels huge this week.
It is. It's not just any earnings report. It's widely seen as this critical test of the market's most dominant and, frankly, most richly valued investment theme right now. The AI boom.
Yeah.
Its outcome is going to reverberate likely across the whole tech sector, maybe even the broader indices. It could either validate this incredible run we've seen or, cast a real shadow of doubt.
So it sounds like, especially in the West, markets have pretty much priced in the good news about the rate cut already. That initial burst of excitement from Powell on Friday, it's been absorbed, and now investors are looking ahead maybe a bit nervously at these hurdles.
You've absolutely nailed a crucial insight there. The market conversation, it really has evolved, even just from a few days ago.
How so?
It's really no longer a question of if the Fed will cut rates. That seems almost a done deal now. Futures traders are pricing in, over an 85% chance for September?
Yeah, very high probability.
Right. So now the real market debate has fundamentally shifted. It's about how deep this easing cycle will be. Is it going to be a dovish cut, the start of a sustained series of rate reductions, or more like a hawkish cut, maybe just a one-off adjustment to guard against a downturn, but without promising more?
Right, like a one and done maybe?
Could be. And then beyond the Fed, the market's grappling with this other profound question. Can corporate earnings, especially in tech, actually justify these really high valuations?
Yeah, valuations are stretched.
In what might be a slowing economic environment. And this creates this state that some analysts are calling positive apprehension.
Positive apprehension. Explain that.
Well, investors are feeling good. They're buoyed by the prospect of more liquidity from the Fed, easier money. That feels positive.
Sure.
But at the same time, they're acutely aware that the very data justifying that rate cut, like a cooling job market, slower growth, could also signal a broader economic slowdown that actually hurts corporate profits.
I see. It's a double-edged sword.
Exactly. So for you, the listener, this positive apprehension really reveals the market's current paradox. It sort of desperately needs just enough bad news to make the Fed cut rates.
Right.
But not so much bad news that it tanks corporate earnings. It's this really delicate dance. Investors are kind of rooting for a bit of an economic chill, but dreading a full-blown freeze.
Yeah, that makes sense. It's a very fine line.
It is. And this fragile balance makes the market incredibly sensitive to every single piece of data that comes out this week.
Okay, let's zoom in now specifically on the U.S. equity markets. What we saw on Monday was definitely a post-rally pause.
Clear shift from Friday.
Yeah, after that powerful surge Friday, the Dow hit its first record close of 2025. Remember, U.S. markets took a very defensive step back to start the week.
Profit-taking.
Definitely felt like some profit-taking, maybe some strategic repositioning ahead of what's clearly, as we've said, a massive week for data and earnings.
Makes sense.
The Dow, which had jumped almost 2% Friday, actually led the declines on Monday. It fell 304.65 points. That's 0.67%, closing at 45,327.09.
Okay.
And the S&P 500, the broad benchmark, also dipped, losing 0.20% to close at 6,453.86. Was this pullback just, healthy consolidation after a big run, or maybe something more concerning?
I think it certainly had elements of healthy consolidation, yes, but there was definitely an undercurrent of caution there, too.
Okay.
What's interesting, though, is that the NASDAQ composite actually bucked that broader trend. It showed quite a bit of resilience.
Oh, really? It finished up?
Yeah, it actually managed to add 0.1%, finished the day at 21,518.03.
Huh. Why the difference?
Well, that outperformance was largely propped up by strength in a few mega-cap tech stocks. We saw notably some pre-earnings buying NVIDIA. It rose 2.1%.
Ah, the NVIDIA effect already.
Exactly. And Alphabet, Google's parent, also had a strong day, up 2.0%. So this really highlights how selective the market's strength is right now. Even on a down day overall, the market seems laser-focused on those few huge names, especially the ones tied to AI. It suggests that while some folks were taking profits, others were maybe strategically adding to their highest conviction tech plays, perhaps betting on a strong NVIDIA report later this week.
Got it. Now, let's pivot to the S&P 500 sectors because, wow, what happened there was almost a night and day reversal from Friday.
Complete flip.
It was like flipping a switch. Friday, we had that euphoric risk-on rally. Economically sensitive sectors led the charge. Consumer discretionary jumped 3.0%. Energy gained 2.0%. Materials rose 2.0%.
Yeah.
Even defensive consumer staples, the safe stuff, was flat.
Risk was definitely on.
But Monday, totally different picture. It tells a really fascinating story about where investors decide to put their money or maybe where they took it out from.
Indeed. Monday's trading, you saw caution, and some very specific industry headwinds really take center stage. A sharp contrast to Friday's broad enthusiasm.
Okay, break it down for us. Consumer discretionary, the big winner Friday.
Right. Consumer discretionary, XLY, which led the pack Friday, faced some pretty significant headwinds on Monday. A key reason was the reemergence of trade policy risk.
The tariff talk again.
Exactly. Reports started circulating that the Trump administration was considering higher tariffs, specifically on furniture imports.
Yeah.
And boom, that news sent shares of furniture retailers tumbling. Wayfair, for example, fell more than 7%. RH was down sharply, too.
Wow, immediate impact.
Immediate. And it really underscores how vulnerable that sector is to trade disputes. It threatens to squeeze their operating margins, and they're already dealing with the prospect of slowing consumer spending. So for you, the listener, this shows just how quickly those geopolitical headlines can hit specific industries right in the bottom line.
Yeah, tariffs aren't just some abstract concept. They hit company profits, investor confidence almost instantly.
Absolutely. Now, moving over to energy, XLE, that sector actually continued to find support. It built on its 2% gain from Friday.
Okay, what was driving that? Oil prices.
Yeah. The main driver was another increase in the price of WTI crude oil. It actually rose for the first time in 3 weeks. Analytically, some experts are suggesting the sector might be getting close to a cyclical bottom. They're expecting U.S. inventory levels to maybe deteriorate, leading to a potential drop in domestic production.
Okay.
And that could offset some of the extra supply expected from OPEC, plus potentially putting a floor under oil prices. It suggests maybe a more resilient demand outlook, especially if the global economy manages to avoid a deep recession.
Interesting. Okay, what about financials? XLF. They had a good run Friday on those rate cut hopes. Did that keep going?
Financials actually gave back some of their strong Friday gains.
Oh, okay. Why?
Well, they'd rallied initially on the idea that lower rates would boost the economy, lending, investment banking, all that.
Right.
But the slight backup we saw in Treasury yields on Monday probably cooled some of that optimism. Higher bond yields can sometimes squeeze bank profits, their net interest margins.
Makes sense.
So the sector saw some consolidation as investors maybe just reassessed how quickly those rate cuts are really coming and how deep they'll be.
Got it. And information technology, XLK. You mentioned NVIDIA and Alphabet were strong, but what about the rest?
Yeah, IT had what we call a bifurcated performance, meaning it wasn't all moving in the same direction.
Okay.
As we said, those strong pre-earnings gains in NVIDIA, the bellwether, and the solid rise in Alphabet, they provided crucial support, especially for the NASDAQ.
Right.
But the broader tech sector outside of those giants was much more subdued. Investors are clearly just waiting, holding their breath for NVIDIA's report on Wednesday.
That make or break moment.
Exactly. That single earnings release is really seen as a potential turning point for this whole AI-driven narrative that's been the main engine for the market for, over a year now? The rest of the sector is just waiting.
Okay. And lastly, consumer staples, XLP. They lagged on Friday, which usually happens when investors are feeling risky and chasing growth. How did they do Monday?
Consumer staples, yeah, the defensive plays, they continue to lag on Monday as well.
Still out of favor.
Still out of favor. These companies selling essential goods, food, household products, they're usually liked in downturns for stable demand, but they tend to underperform when people extend economic stimulus, like rate cuts.
Right. Money flows elsewhere.
Exactly. Investors are seeking higher returns in those more cyclical or growth areas. This really sharp rotation we saw in sector leadership between Friday and Monday, it's like a perfect little microcosm of the market's internal conflict right now.
How so?
Friday was just pure celebration of rate cuts, risk on, cyclicals, and growth soaring. Monday, though, felt like a reality check. Specific risks, like those trade tariffs, popped back up, and investors prudently trimmed back on Friday's biggest winners.
Yeah.
This rapid back and forth, it just underscores this lack of deep-seated conviction beyond a couple of key themes, like AI. And it highlights how sensitive the market is to the daily news and these upcoming data points. It tells us investors are reevaluating risk and reward almost constantly right now.
That sector rotation really does paint a picture of shifting sentiment, doesn't it? Like watching the tide roll in and then quickly roll back out. But to really get the full picture, we need to look under the hood at the market internals. What were they signaling about conviction? Or maybe the lack of it?
Yeah, looking beneath the surface, the market internals definitely gave more evidence of that shift toward caution. Let's talk about market breadth first.
Okay, advancers versus decliners.
Right. Now, we didn't get the full final U.S. breadth data for Monday in our sources for this deep dive, but Friday set an incredibly high bar. On Friday, advancing stocks just overwhelmed decliners on the NYSE by a massive 9.43 to 1 ratio.
Wow, that's huge breadth.
Exceptionally broad participation, real conviction behind that rally. But contrast that with Monday. Even in the Indian market, where the main index actually rose, the sentiment underneath was described as bearish.
Interesting. How so?
On the Bombay Stock Exchange, 2,237 stocks actually declined, while only 1,948 advanced. So even with the index up, more stocks were falling. That suggests underlying weakness beyond just those big index drivers. It signals a narrowing of market leadership. And for you, the listener, narrowing leadership is often seen as a warning sign, a potential precursor to broader consolidation or even a pullback, because fewer and fewer stocks are doing the heavy lifting.
That's a really significant detail. Not all boats rising with the tide, even where indices were green, suggests a more fragile market underneath, maybe.
Exactly. Then you look at trading volume. On Friday, U.S. exchanges saw really strong volume, about 17.93 billion shares traded.
Yep.
That was well above the 20-day average.
Sorry, indicating conviction.
Right, strong institutional buying behind that rate cut rally.
Right.
Now, Monday's volume is going to be a key thing to watch as the final numbers come in. A pullback on light volume. That usually suggests healthy consolidation, just investors taking a breather.
Right.
But a decline on heavy volume, that would indicate more aggressive selling pressure, maybe a deeper shift in sentiment.
Okay. And what about volatility? The VIX, the fear gauge, did that reflect this returning anxiety?
Oh, it absolutely did. The VIX provided a crystal clear picture of that rapid sentiment shift.
What did it do?
On Friday, the VIX plunged, fell sharply by over 14% to a low of 14.22. That showed fear just dissipating, risk appetite surging after Powell spoke.
Good.
But that trend reversed sharply on Monday morning. The VIX jumped 6.33% to 15.33.
Back up again.
Back up. A clear signal that investor anxiety was returning as the market started bracing for this week's crucial inflation data, and of course that make-or-break NVIDIA earnings report. So for you, the VIX isn't just some abstract number. It's like a real-time gauge of the collective unease, the caution that crept back into the market on Monday.
That rapid flip-flopping between sectors and the cautious internals, it really paints that picture of domestic uncertainty in the U.S.
Yeah.
But if we pull back the lens again, the global dashboard tells an even more distinct story, almost like a tale of three different regions on Monday.
Yeah, quite divergent.
Let's start with Europe. Markets there closed broadly lower, seemed unable to build any momentum from Friday's positive cues. What's driving this inability to sustain a rally over there?
That's right. European equity markets ended Monday in the red, pretty much succumbing to that cautious global mood we've been talking about. The Stalo XX Europe 600, the big pan-European index, finished down 0.44%.
Okay.
Germany's DAX closed down 0.37%. But France's CAC 40 was a real underperformer, fell a notable 1.59%.
Wow, that's a bigger drop. Any reason?
Yeah, it seemed exacerbated by weakness in some big industrial and infrastructure names like Vinci. Their shares fell almost 6%. And it's worth mentioning, the UK market was closed for a bank holiday, so that limited the overall regional trading volume.
Okay.
But what's really noteworthy about this negative performance is that it happened even though Germany released better than expected IFO business climate data. Usually that kind of positive surprise would give the market a bit of a lift.
So good local economic news wasn't enough to cheer up the continent. That seems like a strong sign that external factors are really dominating.
Precisely. That dynamic strongly suggests that the big global macroeconomic drivers specifically, this ongoing uncertainty about the Fed's path and the persistent risk of new trade tariffs, are currently just overriding those positive regional signals. The market's inability to rally on good local news tells you that investors are looking past those domestic green shoots. They're focused on the larger, more impactful story coming out of the U.S. It's just a clear demonstration of how interconnected global markets are and how incredibly influential the Fed's stance still is for everyone.
Okay, a clear contrast to that was Asia. While Europe was retreating, Asian markets absolutely caught the bid, as they say, posted a strong session, broadly rallying as they got their first real chance to react to Powell's dovish signals from Friday.
Yeah, they definitely embraced it.
It's almost like they were seeing the glass half full while Europe was seeing it half empty, maybe.
That's an excellent way to put it. That prospect of lower U.S. interest rates, it makes borrowing easier, tends to spur investment in growth assets. That dynamic was a huge tailwind for Asia's tech-heavy indices.
Give us some examples.
Sure. Japan's Nikkei 225 gained year low 0.4%, led by big tech names like SoftBank Group, up 3.5%, and chip tester Advantest, up 1.1%.
Oh,
Hong Kong's Hang Seng Index surged 1.94%, and the Hang Seng Tech Index climbed an impressive 3.14%.
wow. Tech really leading there.
Absolutely. Mainland China, the Shanghai Composite jumped 1.51%, hit its highest level in a decade, actually. And it was accompanied by the highest trading turnover of the year, suggesting strong investor participation, renewed confidence.
Okay.
Even India's Nifty 50 saw optimism, pushing up towards that 25,000 level. It was just a broader regional wave of bullishness, really fueled by that dovish Fed pivot.
So what does this all mean, especially in China, where we saw, as you mentioned, this outsized rally, but it was in both technology and rare earth stocks? That doesn't feel like just one simple story of a rising tide lifting all boats, does it? It seems more complex.
It absolutely points to a dual narrative, and in some ways, maybe even a contradictory one unfolding specifically in the Chinese market.
Oh, you unpack that for us.
All right. The rally in the broader tech sector, that's a direct first-order reaction to the global liquidity story we just talked about.
Right. Fed easing helps growth stocks everywhere.
Exactly. Makes growth stocks globally more attractive, boosts risk appetite generally. Simple enough. However, the surge we saw at the same time, and just as significant, in rare earth stocks. That's a totally distinct narrative.
Okay. Not driven by the Fed, then.
Not directly. It's rooted much more deeply in industrial policy and geopolitics. This move was sparked by a specific policy announcement from Beijing. They plan to strengthen their oversight and control over the production and trading of these critical minerals.
Ah, okay. Why is that significant?
Well, it has major implications. It suggests investors are positioning themselves for a global landscape where strategic resources and China's dominant control over many of them become increasingly critical leverage points.
Especially with U.S.-China tensions.
Yeah.
Right? And a tech race.
Precisely. It's highly relevant in the context of ongoing U.S.-China trade friction and the global race for tech supremacy, where access to these materials is absolutely vital for advanced technologies, everything from EVs to defense systems.
So what's the investor play here?
It looks like investors in China are playing both offense and defense at the same time. They're participating in the global liquidity-driven rally through tech stocks, that's the offense.
Got it.
But they're also making a strategic defensive bet on China's ability to leverage its control over critical materials as a tool in its long-term economic and geopolitical competition with the U.S.
Fascinating. Playing both sides.
Exactly. The underlying insight here for you, the listener, is that in today's complex world, simple single-story narratives often just don't cut it anymore. Investors increasingly have to dissect and position for multiple, sometimes conflicting macro and geopolitical forces playing out all at once.
Yeah.
It just makes market analysis inherently more complicated.
Okay, let's dive deeper now into those macroeconomic drivers. Federal Reserve Chair Jerome Powell's Jackson Hole speech on Friday, clearly the catalyst for the week's trading action. Many analysts are calling it the Powell pivot, signaling a pretty significant shift. Can you elaborate on the details? What exactly shifted, and why was it so impactful?
It really was a very significant dovish shift in the Fed's public stance, and the market's reaction just underscored how important it was.
What was the core message?
The catalyst was Powell explicitly signaling that, yes, a rate cut could be warranted, perhaps as soon as the September meeting. And his justification was key. He highlighted that the balance of risks appears to be shifting.
Okay, shifting how?
He pointed specifically to growing concerns about the health of the U.S. labor market, suggesting it was showing signs of cooling off.
Right.
And the market's response was, well, immediate and decisive. Traders in the Fed funds futures market just piled in, rapidly increasing their bets on a September rate cut.
What did the probability jump to?
The implied probability of a quarter-point cut in September, it went from around 75% before he spoke to over 85% by Monday, according to the CME FedWatch tool.
Wow, big jump.
Huge jump. And this fundamental shift has really altered the market's focus. The debate is no longer primarily about whether the Fed will restart its easing cycle this year.
Right, that seems decided now.
Pretty much. Now the focus is squarely on the pace and depth of that cycle. How far will they go? Current market pricing, after Monday's trading, seems to imply expectations for about 2 quarter-point cuts total by the end of 2025.
Okay, so the conversation really has moved from if a cut is coming to how many cuts are we actually likely to see?
Yeah.
But is the whole committee, the FOMC, are they all on board with this new, more dovish stance? Or is there still some internal debate happening?
That's a crucial point. And the answer seems to be not entirely, which of course adds another layer of nuance and uncertainty for the market.
Okay, so what's the debate now?
Well, this pivot has really ignited a new debate among analysts, investors, everyone about the precise nature of the easing to come. The key question is, will that likely September move be a dovish cut? Meaning, does it signal the start of a sustained easing cycle, maybe several cuts over the next year?
Okay.
Or will it be framed more as a hawkish cut, like a one-off recalibration of policy, just designed to guard against an excessive slowdown, but without committing the Fed to further aggressive action down the road?
Right. Is the committee divided on this?
It appears so. While Powell's comments definitely set a dovish tone, clearly leaning towards easing, other officials are sounding more cautious. Cleveland Fed President Beth Hammack, for example, she expressed reluctance to cut rates based on the current data, pointing to those persistent inflation concerns.
Okay, so still hearing from the inflation hawks.
Exactly. This division within the FOMC means the market is watching not just Powell, but also these dissenting voices, future speeches, trying to gauge the real consensus and the true long-term path for policy. This internal conflict, it just creates volatility and keeps investors on edge.
Okay, so beyond the Fed speak, which can get pretty abstract, what did Monday's actual economic data tell us? You said it was a mixed but informative picture globally.
It was indeed. Monday's data releases, they gave us a mixed picture, yeah. Characterized maybe by surprising resilience in Germany and continued, albeit pretty mild softness in the U.S.
Okay, start with Germany. What was the news there?
The Germany IFO Business Climate Index for August, it actually improved unexpectedly, rose to 89.0 from 88.6 in July, beating the forecasts.
What drove the improvement?
It was mainly driven by a significant jump in the expectations component, which climbed to its highest level since way back in February 2022.
Okay, so businesses are feeling better about the future.
Seems like it. Despite maybe a slight dip in their assessment of current conditions, German businesses are growing more optimistic about the future economic outlook. That's a positive sign for the Eurozone's biggest economy, maybe suggesting the worst of its slowdown could be behind it.
Okay, a little bright spot for Europe then, suggesting some underlying strength maybe. What about the U.S. data? Did it back up Powell's idea of a cooling economy?
In the U.S., the picture was more nuanced, leaning towards a modest cooling, I'd say. The Chicago Fed National Activity Index for July, that's a broad measure of economic activity and inflation pressure, came in at -0.19.
Okay, negative. What does that mean?
A slight decrease from June's -0.18. A reading below zero suggests the national economy is expanding, but at a rate below its historical trend.
Okay.
The underlying parts showed widespread, though not severe, weakness. 3 out of the 4 main categories actually drag the headline index down. So that kind of aligns with Powell's talk about a shifting balance of risks.
Got it. What else came out?
Then we had the U.S. Dallas Fed Manufacturing Index for August. That fell back into contraction territory, down to -1.8 from +0.9 in July.
Okay, weaker manufacturing there.
The headline was weaker, yes. But interestingly, the report's details were actually a bit more encouraging. The new orders index turned positive for the first time since January, and the shipments index surged to its highest reading in over 3 years. So some pockets of strength in there.
Okay. Mixed signals again. What about inflation in that report?
Yeah, critically for the inflation outlook, the survey showed price pressures are still elevated. The raw materials prices index edged up to 43.7, still well above its historical average.
Okay.
And firms also mentioned the negative impact of tariffs, with many saying they're passing those increased costs onto their customers. So for you, the listener, the data really is a true mixed bag. You've got hints of economic deceleration that could justify a Fed cut, but also these persistent inflation pressures that could really limit how much room the Fed has to maneuver.
Right. So while Monday's data gave us some useful context, it really feels like the market's primary focus, almost its singular obsession, is on those upcoming U.S. economic releases later this week. What's the main event everyone's waiting for?
Absolutely. The main event, the most critical data point, no question, is the release of the Personal Consumption Expenditures, or PCE, price index for July. That's coming this Friday, August 29th.
The Fed's preferred measure.
As we've said, yes, their preferred inflation gauge. It's going to be a crucial input for that September FOMC meeting.
What are the expectations?
The consensus forecast among economists is for the headline annual PCE inflation rate to hold steady at 2.6%, unchanged from June, and still stubbornly above the Fed's 2% target.
Okay. And core PCE.
The core PCE index, which strips out food and energy, gives a better sense of underlying trends. That's also expected to show persistent underlying price pressures. It was at 2.8% annually in June. So these are numbers that, yeah, they're coming down, but they're still above where the Fed wants them to be.
And the implications of that report are just huge, aren't they? I mean, a hotter than expected reading would really put the Fed in a tough spot.
They are immense. The outcome of this PCE report carries significant weight. It could really dictate market direction for weeks. A hotter than expected inflation reading, that creates a real dilemma for the Fed.
How so?
It could potentially force policymakers to adopt more hawkish forward guidance, kind of dial back expectations of a deep easing cycle, even if they do go ahead with that September cut everyone expects.
Right.
And that would likely cause bond yields to rise, the dollar to strengthen, put renewed pressure on stock valuations as the market rethinks that how deep question.
And the flip side, a softer reading.
Conversely, a softer than expected reading. That would be seen as a clear green light for more aggressive easing. It could reignite a broad market rally by validating the current dovish positioning.
Okay. Any other data points to watch this week besides PCE?
Yeah. Other important U.S. releases include the August Consumer Confidence Survey, July durable goods orders, and the second estimate of Q2 GDP. They'll all feed into the overall picture, but PCE is, without a doubt, the heavyweight champion this week.
Okay, let's broaden our view again and look at the cross-asset market analysis. Because the interplay between different markets, bonds, commodities, currencies often reveals those deeper anxieties and expectations.
Yeah, they talk to each other.
Exactly. And we saw kind of a nuanced signal from the U.S. Treasury market, for instance. Yields actually rose on Monday, despite those heightened rate cut expectations. That feels counterintuitive. Why would bond yields go up when the market's betting heavily on lower rates coming soon?
Yeah, this is indeed what we often call counterintuitive price action, where bond yields rise even as the market seems to be pricing in more aggressive Fed easing. And it's an important indicator of the market's underlying concerns and complexities.
What happened with yields specifically?
The yield on the benchmark 10-year Treasury note, it rose to 4.28% from 4.25% late Friday. The official close was reported at 4.274%. Okay.
And the two-year yield, which is usually more sensitive to near-term Fed policy expectations, that also ticked higher, rising to 3.73% from 3.70%.
So why did they go up? What are the factors?
Well, there are likely several factors at play. First, probably just a degree of profit-taking after yields fell pretty sharply on Friday, right after Powell's speech.
Okay, some technical selling.
Some technical selling, sure. Second, and probably more significantly, it represents investor hedging and repositioning ahead of this week's crucial PCE inflation report.
Betting against a good inflation number.
Or at least hedging against a bad one. A higher than expected inflation number would definitely put upward pressure on yields, so some investors are positioning for that risk.
Okay. Any other reasons?
Finally, the rise might suggest a belief among some bond market players that even if the Fed does deliver that cut in September, persistent inflation is going to prevent the central bank from launching into a really deep and rapid easing cycle.
This would keep those longer-term yields anchored at higher levels, reflecting the market's deep-seated anxiety about inflation sticking around. So for you, the listener, the bond market is essentially saying, yeah, okay, a cut's probably coming, but let's not get carried away about how many cuts because inflation is still a very real problem.
Got it. So the bond market is signaling caution about the extent of future easing, even while stocks were initially celebrating that first cut. Okay, what was the pulse in the commodities market? Were they signaling confidence in future demand, or were there mixed signals there too?
Commodity markets were maybe predictably mixed on Monday, kind of reflecting that underlying tension we saw elsewhere.
Okay, start with energy. You mentioned oil was up.
Yeah, in energy, West Texas Intermediate crude oil prices rose for the first time in 3 weeks. The front-month contract gained over 1.7%, settling around $64.80 a barrel.
What supported that rise?
Two main things, really. Ongoing geopolitical uncertainty in key producing regions, potential supply disruptions always linger. And also that broader market optimism that Fed rate cuts will eventually stimulate stronger business and consumer demand, which would boost energy consumption globally.
Okay, so energy feeling a bit optimistic. What about precious metals? Like gold.
Precious metals, specifically gold, prices were largely unchanged. The front-month COMEX contract settled down just a tiny bit, 0.02%, at $3,373.80 per troy ounce.
Why so flat? Isn't lower rates usually good for gold?
Yeah, the prospect of lower interest rates and a potentially weaker U.S. dollar is a fundamental long-term tailwind for non-yielding assets like gold. Makes them more attractive compared to bonds.
Right.
But the price action was muted on Monday. It seemed held in check by those offsetting forces.
Yeah.
The slight rise we just talked about in Treasury yields and a relatively stable U.S. dollar.
Okay.
Gold is still near its historically high levels, though. It seems poised, really waiting to react significantly to this week's inflation data. That will be key for determining real yields, which is a major driver for gold.
So energy showing some demand optimism, but gold is kind of in a holding pattern, waiting for that inflation clarity. Makes sense.
Pretty much, yeah.
And lastly, the currency markets. The U.S. dollar showed some resilience, didn't it? Despite that increasingly dovish outlook for Fed policy. This also feels like it goes against the usual script, where a dovish Fed tends to weaken its currency. What's behind the dollar's strength?
That's a sharp observation, yeah. The U.S. dollar index, the DXY, which measures the dollar against a basket of other major currencies, it actually ticked 0.20% higher to 97.90.
So why stronger when rate cuts are expected?
It likely reflects a safe haven bid. As investors got a bit nervous with the pullback in U.S. stocks and these persistent global uncertainties, they sought refuge in the dollar.
The flight to safety trade.
Exactly. When global markets get jittery, the dollar often benefits from that. Now, historically, you're right, the dollar does tend to weaken when the Fed is easing because lower interest rates make dollar assets less attractive compared to higher-yielding alternatives elsewhere. So a sustained, softer U.S. dollar is widely expected if the Fed really proceeds with a full easing cycle. And that would then provide a tailwind for things like precious metals and also emerging market assets as their goods become relatively cheaper.
So Monday's strength might just be temporary.
It could well be a temporary pause in that longer-term potential downtrend. More a reflection of immediate risk aversion than a fundamental shift in the dollar's likely trajectory. It's just another sign that even with dovish Fed signals, global stability, or the lack thereof, remains a key driver.
All right, this is where things get incredibly compelling, I think, because no single event looms larger for the market this week than NVIDIA's Q2 earnings report that's coming after the close on Wednesday, August 27th. This really feels like the NVIDIA earnings crucible.
Crucible is the perfect word, yeah.
Given the company's just massive influence, what exactly is at stake here?
Yeah, Crucible fits because NVIDIA isn't just a company anymore. It's become the market bellwether. It's basically synonymous with this whole AI boom.
Right. World's most valuable company now.
Exactly. Market cap over $4.3 trillion. Undisputed leader in AI accelerators. So its results, its forward guidance, they're seen as this crucial barometer for the health of the entire tech sector, and maybe even the sustainability of the broader market rally itself.
What are the expectations like? Are they high?
Oh, they're extraordinarily high. Wall Street is anticipating another quarter of truly staggering growth. The consensus estimate is for adjusted earnings of $1.01 per share. That's up 48% year over year.
Wow.
On revenue of more than $46 billion, that's a jump of 54% from last year.
Incredible numbers. Any specific area to watch?
The most closely watched metric, without a doubt, will be sales from its data center segment. Analysts are projecting that will hit $40.9 billion. That's the core of its AI dominance. Any miss there, any deviation from these huge expectations will be scrutinized instantly.
So beyond just those headline numbers, which are already stratospheric, what are the key qualitative things investors will be digging into? You know, in the earnings call, the report details. What could really move the needle?
Investors are going to be meticulously combing through several key areas. First, the company's forward guidance. Any hint of slowing demand from its biggest customers, the hyperscalers.
Right, the big cloud providers.
Yeah.
Microsoft, Google, Amazon.
Exactly. They collectively account for about 40% of NVIDIA's revenue. They're the ones building out all the AI infrastructure. So any sign that their spending might be slowing down, that would be a major red flag for NVIDIA and the whole sector.
Okay.
What else? Second, management's commentary on its business in China will be absolutely critical.
Ah, right. There was that recent deal with the Trump administration.
Yes, that complex agreement allowing NVIDIA to resume some sales of its high-end chips to China, but in exchange for a 15% revenue-sharing deal with the U.S. government.
Okay.
That detail is crucial. It provides a path for continued, albeit maybe modified, access to that massive Chinese market while trying to address those geopolitical security concerns. How that's playing out will be key.
Got it. What are the options markets pricing in for a move?
The options market is pricing in a pretty significant post-earnings stock move, about 6.5% in either direction by the end of the week, reflects the extremely high stakes here.
And analyst sentiment. Still bullish.
Overwhelmingly bullish. Nearly 90% of analysts covering the stock rate it a buy or equivalent. Numerous firms have raised their price targets just in the run-up to this report.
Wow. That really sounds like an exceptionally high bar to clear, doesn't it? I mean, with so much optimism already baked into the price, what are the risks if they don't absolutely nail it?
It absolutely is an exceptionally high bar, maybe one of the highest we've ever seen for a company this big. And this backdrop, this immense expectation, it creates a situation where even a modest miss maybe on results, or maybe just a slight disappointment in the guidance, like forecasting slightly slower growth next quarter,
Yeah.
that could spark a significant sell-off. And because of NVIDIA's huge influence and valuation, it could reverberate across the entire market.
Right. Risk of contagion.
Definitely. It truly feels like a make-or-break moment for the AI narrative that's pushed so much of this market higher. Disappointment here could genuinely trigger a broader tech sector correction as investors start questioning the sustainability of current valuations across the board.
And conversely, if they beat.
Conversely, an unequivocally strong report, beating expectations, strong guidance, that could provide the fuel needed to extend this current tech-led rally even further. High stakes indeed.
Okay. Beyond the giant NVIDIA, let's delve into some other specific companies that saw significant moves on Monday. They often give us little glimpses into sector-specific challenges or opportunities.
Certainly. Let's start with Keurig Dr. Pepper, KDP. Shares of the beverage giant were actually the worst performers in the S&P 500 on Monday, plunged somewhere between 8% and 11% during the day.
Ouch. What happened there?
The sharp drop was triggered by this announcement of a really complex strategic move. First, they plan to acquire JDE Peet's, the owner of Peet's Coffee, for a whopping $18 billion to create this global coffee giant. But then, subsequently, they plan to separate the whole thing into two distinct publicly traded companies. One for coffee, one for soft drinks.
Wow, that sounds complicated.
Yeah.
How did the market react?
Deeply negatively, obviously. It suggests significant investor skepticism about the deal's valuation, about the strategic complexity of trying to pull off that split, and maybe ongoing concerns about the performance of KDP's existing U.S. coffee business, which has actually seen shrinking sales recently.
Yeah, investors often get nervous about really complex multi-step deals like that, right? Especially if there are questions about core growth.
Exactly. A lot of moving parts there that clearly spooked investors, questioning both the strategy and their ability to execute it smoothly.
Okay. On the flip side, Intel,
Yeah.
INTC. You mentioned it continued its recent positive run.
Yeah, Intel shares rose about 2% on Monday. This was really a continuation of the rally that started Friday, driven by that late-breaking news that the U.S. government has taken a 10% equity stake in the company.
Right. Big news. How is that being interpreted?
It's widely seen as a strong vote of confidence in Intel's turnaround efforts, and also as a strategic investment by the government to really bolster the domestic semiconductor manufacturing industry. It aligns with those broader national security and economic goals.
So capital injection plus a government seal of approval, basically.
Pretty much. A powerful endorsement of Intel's long-term strategic importance.
Okay. And going back to those trade policy risks you mentioned earlier, we saw that direct hit on furniture retailers really confirms these aren't just theoretical worries.
Absolutely. Shares of furniture companies took a sharp dive. Wayfair dropped more than 7%. RH Williams-Sonoma also posted significant losses.
And the trigger was just the report of potential tariffs.
Yes. The decline was a direct, immediate reaction to reports that the Trump administration is considering new, higher tariffs on furniture imports. It just instantly reignited those trade war fears that pose a direct threat to the sector's profitability.
How does it hurt them?
Increases their import costs, potentially reduces consumer demand if prices go up. Retailers usually operate on pretty thin margins, so even a small increase in costs can have a big impact on their bottom line. Investors just headed for the exits.
Got it. What were some other big individual stock movers that caught your eye on Monday? Any interesting stories there?
Well, Sasol Limited, SSL, those are the American depository receipts for the South African energy and chemical company. It surged over 11%, made it one of the day's top gainers.
Wow. What was the catalyst? Good earnings.
Exactly. The catalyst was the release of their full-year audited financial results. Now, interestingly, their turnover, their revenue, was actually down 9% because of lower oil prices and sales volume.
Okay, so why the surge?
Despite lower revenue, they reported a remarkable 93% improvement in headline earnings per share and a 75% jump in free cash flow.
How'd they manage that?
Attributed to disciplined cost controls, lower impairment charges on assets, and also a significant one-time payment they received from a legal settlement. So it just shows that even in a tough environment, strong operational execution and good financial management can still deliver really impressive bottom-line results.
Good example of managing what you can control. Okay, what about on the downside? Any notable losers besides KDP and the furniture guys?
Yeah, on the other end, Sarepta Therapeutics, SRPT stock, was among the day's biggest losers, fell more than 10%.
Oof. What was the issue there? Drug trial news.
The selling pressure seemed linked to the fact that Monday was the deadline for investors to seek lead plaintiff status in a class action lawsuit filed against the company.
Ah, legal overhang. What's the lawsuit about?
It alleges that Sarepta made false and misleading statements about the safety profile of its Duchenne muscular dystrophy gene therapy called Elevidys.
Okay. Has there been safety news?
Yes, this follows two separate tragic patient deaths from acute liver failure, which led to clinical trials being halted and the drug's distribution being temporarily suspended for certain patients earlier this year. So these legal and safety concerns in biotech, they can be incredibly damaging to investor confidence, as you can imagine.
Absolutely. A very difficult situation for everyone involved. Any other notable gainers or losers from the broader market that maybe highlighted a particular theme or risk?
Well, among the day's top gainers, just looking at significant percentage moves, was a company called SuperX AI Technology, SUPX, surged over 38%.
Okay. Big AI news.
Apparently not. No specific news catalyst was identified for that dramatic move on Monday. It suggests it was driven largely by just strong momentum and speculative interest in the AI sector generally.
Right. Chasing anything with AI in the name.
Seems like it. A reflection of that continued enthusiasm may be more on the retail side, despite the broader market caution. It kind of indicates that while the big institutional money might be waiting on NVIDIA, speculative capital is still looking for AI plays wherever it can find them.
Got it. And on the losing side.
Conversely, among the top losers, alongside KDP and Sarepta, were some of those volatile meme stocks like Newegg Commerce, Neji, down over 15%, and Palabelli Group, PLBL, down more than 17%. Just highlights the inherent risks and those rapid reversals you often see in the more speculative corners of the market. These stocks often move more on social media sentiment than fundamentals, making them prone to really sharp, unpredictable swings. #tag outro.
So as we wrap up our deep dive into Monday, August 25th, 2025, it's abundantly clear, isn't it? It was really a day of strategic digestion, maybe repositioning for global markets.
Absolutely. A pause day.
That initial euphoria that followed the Fed's dovish pivot seems to have been fully absorbed now, and it's given way to a much more sober, more nuanced assessment of the risks that are lying right ahead. That clear divergence we saw rallying Asian markets still catching up versus consolidating Western markets really highlights that transition. The U.S. market, having led the charge Friday, now feels like the focal point of caution, really entering a holding pattern ahead of two truly critical tests this week.
And these two pivotal events, they will almost certainly dictate the market's trajectory for the coming weeks, maybe even months. They're likely to break this current impasse we're in.
Okay, remind us again, test number one.
First, NVIDIA's earnings on Wednesday. The importance of this single report, as we've said, just cannot be overstated. A strong release, bullish guidance, that validates the whole AI rally, provides the earnings support needed to maybe push indices higher.
And the downside.
Conversely, any weakness, any miss, that could effectively prick the perceived AI bubble, potentially triggering a significant tech-led market correction.
Okay, and test number two.
Second, and equally critical, is that PCE inflation report on Friday. This data will be the final arbiter, really, of the Fed's near-term policy path.
Green light or red light for cuts?
Essentially. A benign reading gives the Fed the unambiguous green light for that dovish cut, likely sparking a broad, enthusiastic market rally. But a hot number. That sows doubt about the Fed's ability to ease aggressively potentially leading to higher yields, a stronger dollar, renewed pressure on stocks. So for you, the listener, the market is really presenting almost a binary choice this week, and the outcome hinges entirely on these two reports.
So for you, our listener, navigating this environment, what's the most prudent strategic approach given these incredibly high stakes?
Well, the current market environment, I think, clearly favors a balanced and cautious strategic approach. Yes, the overarching prospect of Fed easing provides a supportive backdrop for risk assets, maybe especially for rate-sensitive areas like small caps or the broader growth complex.
Right.
But the near-term risks are significant, and as we said, kind of binary in nature. The market's muted defensive posture on Monday strongly suggests that a substantial amount of the good news about rate cuts is probably already priced in.
Right, leaving assets vulnerable.
Exactly, leaving asset prices vulnerable to negative surprises, either on the earnings front with NVIDIA or on the inflation front with PCE. So investors are probably best advised to monitor the upcoming data with extreme vigilance. These releases are very likely to break the current market standstill and establish a clear directional tone for the rest of Q3.
Prepare for volatility then.
Definitely prepare for volatility. And remember, as those market internals showed, conviction remains pretty fragile right now.
This raises a really important question then for you to consider as we head into the rest of the week. If the market is somehow anticipating both economic slowing, which it needs to justify rate cuts, and continued strong corporate growth, which it needs to justify current valuations, how long can those two seemingly contradictory narratives actually coexist before one inevitably has to give way?
That is a great thought to mull over as we head into what promises to be a very, very interesting couple of days.
Indeed. Thank you for joining us for this deep dive. Our Bulls, Bears, and the Bell Afternoon edition will certainly be here to unpack it all as it unfolds.